Hey everyone, welcome back to Corporate Decoder. Today, ING just filed its Q2 2026 report, and I am seeing a mixed bag of performance that needs a closer look. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company's seeing some sales growth, but a concerning drop in rental revenue, and the bottom line is still in the red. Alright, let's dive into what Inogen Incorporated, or INGN, reported for the second quarter of 2026. This is their quarterly report giving us a snapshot of how things are going. First up, the balance sheet. This shows us what the company owns and owes at a specific point in time. As of the 30th of June 2026, Inogen had about $87.3 million in cash and cash equivalents. That is down from about $103.7 million at the end of 2025. So they are using up some of their cash reserves. Their total assets are around $285 million, down from nearly $299 million at the end of last year. On the flip side, their total current liabilities, meaning what they owe within a year, are about $70.9 million, up from around $63.5 million. This increase in short-term debt isn't ideal. And here is a big one. Their accumulated deficit, which is essentially the total net losses the company has had since it started, stands at a negative $187.8 million. This number grew from a negative $175.6 million at the end of 2025, showing they are still losing money overall. Now let's look at how they actually made or lost money in the quarter. This is the income statement, or in this case, the statement of comprehensive loss. For the 3 months ended the 30th of June, 2026, total revenue was about $95.1 million. That is a slight increase from about $92.3 million in the same period last year. The main driver of this revenue is sales revenue, which hit about $83.5 million. That is up by about $4.4 million or 5.5%. So they are selling more products. This increase is partly because they sold more portable units, about 53,300 in the quarter compared to 47,600 last year. However, rental revenue took a hit. It dropped by $1.5 million or 11.8% to about $11.6 million. The company says this is because fewer patients are on their rental service. This is a concerning trend for a business that also rents equipment. Despite the revenue increase, cost of sales also went up, leading to a gross profit on sales revenue of about $38.6 million. Their gross margin on sales actually improved a bit, going from 45.1% to 46.2%. They attribute this to better manufacturing costs and lower warranty expenses. But the gross profit on rental revenue fell significantly, dropping to $4.7 million from $5.6 million. The gross margin here also decreased. Overall, their total gross profit for the quarter was about $43.3 million, a modest increase from $41.3 million. Looking at expenses, research and development went up by about $662,000 to $5.9 million. This shows they are investing in new products, which could be good for the future. Sales and marketing expenses actually decreased slightly by $566,000 to about $24.8 million. They spent more on advertising, but cut back on personnel costs. General and administrative costs rose by $802,000 to $17.7 million, mainly due to higher stockholder engagement and proxy defense costs. This sounds like a company dealing with shareholder activism or maybe some internal disputes. All of this led to a net loss of $3.9 million for the quarter. While this is better than the $4.2 million loss in the same period last year, it still means they are not profitable. Looking at the first 6 months of the year, total revenue increased to $180.2 million from $174.6 million. Again, sales revenue is up, but rental revenue is down. Sales revenue for the 6 months rose by $8.3 million or 5.6% to $155.9 million. Rental revenue for the 6 months fell by $2.7 million or 9.8% to $24.3 million. Total gross profit for the first half of the year was $81.1 million, up from $77.7 million. But operating expenses are also up. Research and development jumped by $1.7 million or 18.7% to $11 million. Sales and marketing stayed pretty flat, while general and administrative expenses increased by $2.1 million to $35.2 million. Largely due to restructuring costs and those proxy defense expenses. This all resulted in a larger net loss for the 6-month period, a 17.9% increase to $12.2 million. So while sales are growing, the company is still struggling to turn a profit and their expenses are climbing faster than their revenue growth. Now, let's talk about cash flow. This tells us where the money is actually coming from and going to. For the first 6 months of 2026, they used $3.7 million in operating activities. This is much better than the $12.4 million they used in the same period last year. They seem to be getting better at managing their cash from daily operations, helped by things like depreciation and stock-based compensation being added back. In investing activities, they used $5.1 million in 2026, which is a lot less than the $24.6 million used in 2025. They invested less in marketable securities and rental assets this year. Financing activities show how they raised or repaid money. In 2026, they used $7.7 million, mainly for repurchasing their own stock. In 2025, they actually brought in $24 million, primarily from selling stock. Overall, their cash position decreased by $16.4 million in the first 6 months of 2026, a bigger drop than the $12.5 million decrease in 2025. This aligns with the fact that they used more cash in operations and financing this year compared to last year. Speaking of cash use, the company authorized a share repurchase program in February 2026, allowing them to buy back up to $30 million of their stock. In the first half of 2026, they bought back about 1.1 million shares for $7.5 million. That leaves about $22.5 million left under the program. This can sometimes be a signal that management thinks the stock is undervalued, but it also means cash is being used that could be invested elsewhere. Let's look at some other key numbers. Their product warranty liability, which is money set aside for potential future repairs, was about $28.4 million at the end of June 2026. This number has been pretty stable. Inventories are valued at $28.6 million, up from $26 million. This increase suggests they might be building up stock, possibly in anticipation of higher sales or to guard against supply chain issues. Something interesting in the equity section is their stock-based compensation. As of the 30th of June 2026, they had about 2.9 million restricted stock units outstanding. The unrecognized compensation cost for these is over $11 million, which will be expensed over the next couple of years. This is a way companies pay employees and can impact future earnings. The company mentions they are involved in various legal proceedings. They believe these won't have a material adverse effect, but litigation always comes with costs and can distract management. As expected in any filing, they list risk factors. These are things that could go wrong and hurt the business. They reiterate risks from previous reports, covering things like competition, supply chain disruptions, and regulatory changes. Nothing fundamentally new here, but it's always important to remember these exist. Looking at the overall trend, Inogen saw its total revenue grow by 3% in the quarter and 3.2% in the first half of the year. This is positive, but the story is more complex. The increase in sales revenue, up 5.5% for the quarter and 5.6% for the half, is driven by international markets and favorable currency exchange rates. They're selling more portable units, which is good, but that drop in rental revenue, down 11.8% for the quarter and 9.8% for the half, is a significant concern. This segment used to be a strong contributor, and its decline suggests potential issues with their service model or patient retention. The improved gross margin on sales revenue, climbing to 46.2%, is a bright spot. This efficiency in manufacturing and lower warranty costs is a positive sign for their product sales. However, the company is still reporting net losses. The loss for the quarter narrowed slightly to $3.9 million, but the 6-month loss widened to $12.2 million. This shows that despite revenue growth and improved sales margins, rising operating expenses are eating into profitability. On the cash flow front, the significant improvement in cash used by operations is a positive. They used much less cash in the first half of 2026 compared to 2025, which is a step in the right direction for financial health. The company is clearly in a turnaround phase. Sales are growing, which is great, but the declining rental revenue and persistent net losses are major headwinds. Management seems to be focused on improving efficiency and potentially future growth through R&D, but they're still burning through cash overall. My biggest concern is the continued decline in rental revenue. If this trend persists, it could significantly impact their long-term profitability, especially since rental margins are generally higher. I'll be watching to see if they can reverse this trend or if they can offset it with even stronger sales growth. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded, like, comment, subscribe, and join the Discord linked in the description.